G'day, my name's Ben Everingham. I'm the director here at Pumped on Property. Now in today's video, on my way to catch up with an absolute legend of a client called Tom in Brisbane, I wanted to talk about 5 lessons that I've learned from as a property investor the hard way. Now, as you all know, I've made some massive mistakes. I almost made one of the biggest ones of my life this week from a property perspective, but luckily I saved my ass. And I wanted to share these with you so that you don't make the same mistakes that I have. And so that wherever you're starting, if it's just your first property, your second, your 5th property, or your 10th, you can learn from these lessons and not make as many mistakes as I had. Now, the first lesson that I learned the hard way was when I bought and speculated on a property, or it was a piece of land, and I built a home on it in a regional market. Now, this was before I knew what I now know, because you and I both know that metro markets do better than regional. You and I both know that houses do better than units, according to the history from CoreLogic. We both know that closer to the city or closer to the beach does well. We know that we do want capital growth long term, as well as great cash flow from our properties, and we want them to be neutrally to positively geared if we can. You know, we both know that we want tenant ready, low maintenance, quality properties in the best pockets of the best suburbs in the best cities of Australia. But 6 years ago, I didn't know all that stuff. And I got a hot tip from someone that I really trusted at the time saying, hey mate, I've just bought this piece of land and I'm going to build on it. I'm set to make it easy $100,000 if I flip it. There's one next door to it. Do you want it? Now, the guy that was telling me this stuff, who I have massive respect for as a business owner, but he wasn't a great property investor, and he hadn't done his due diligence, and he was a builder. So, you know, for me to build next to him, he was making good money out of that build. In fact, he made about $50,000 or $60,000 from that deal. Now, what I did is I took his advice. I think it was the 5th or the 6th property that I'd bought at the time, so I should have known better, but I really, really trusted this guy, and he was successful, and I was young at that time. And he said, you know, just buy one, mate. So I went out there and I bought this piece of land, and then I put together a building product. I put together a building plan, and then just before I was due to settle on the land, but I couldn't terminate the property, it was too late, I recognized that I'd made a massive mistake. Now, the first lesson that I'd learned that I know today that I didn't know then was metro markets, Sydney, Melbourne, Brisbane, Perth, Darwin, Canberra, have outperformed regional markets, Sunny Coast, Gold Coast, Wollongong, Newcastle, Geelong, Ballarat, Bendigo by about 87% on average over the last 25 years in Australia, according to CoreLogic. Now, I wasn't even looking at a major regional market like the ones I mentioned. This was a shitty little regional town, which is a beautiful place to live, but a shitty place to invest, called Kyogle, which is in northern New South Wales, right on the border, but way inland. Now, the first thing I realized is that the average incomes in Kyogle are less than $1,000 a week. So only 6% of the people living in the area actually earned enough money to buy the property that I'd created. Secondly, I created a really expensive brand new product that was at least $250,000 more than what the normal product was in. And it was in the top 1% of sales in the last 5 years, which was a big problem for me, because not only was I looking at only 6% of people living there that could afford it, I was looking at a very niche property that only 1% of all sales had sold for over that, and there were plenty of places with much bigger pieces of land that probably represented better value for less money. Now, I had to go through with the build, and then as soon as I'd finished the build, I started to discount the price. Now, I discounted the price over a period of 7 months it took to sell, which was stressing me out so much because I didn't have any money at that time. I was all in on my other investments. I'd spent everything that I had. The other problem is I'd bought a friend of mine into it, a really good friend who was one of my best men at my wedding, and he, you know, was set to lose money as well. So long story short, I'd bought a regional market, I'd created something without doing my due diligence, and I ended up selling that property for a $40,000 loss. Now, because of the person that I am, I could have done, you know, $20,000 loss for my mate, $20,000 loss for me, but instead I paid my mate out the $20,000 out of my own pocket, and I copped the entire $40,000 loss myself. So massive lessons, still one of my best mates, travel all the time together, spend a lot of time together when I'm in Sydney. I didn't want that relationship to end because at the end of the day, it's only money. But massive, massive, massive lesson. Be careful with regional markets. Be careful, believing what you hear from somebody else, and be careful not doing your due diligence and demographic information and sales history research before you actually buy. Now, that was the first big mistake, and that was probably the most painful of my life at that time. The second major mistake that I made had to do with my team of advisors. Now, a lot of you who are just getting started or that maybe own between 0 and 5 properties, probably have an okay team of advisors, no disrespect, but it took me a long time to find great people. Now, a few years back, I found this property a couple of doors down from the beach on the Sunshine Coast that I wanted to buy. At the time, I was pretty stretched from a servicing perspective, but it was the good old days before they made money really hard to get. And I'd been working with his bank manager at CBA in Mooloolaba. I could pick up this home for $375K, which was an absolute steal even then. And I'd put the property under contract, was going through the motions, and then she just told me that I couldn't get finance. Now, at the time, it was still when I was learning. This was, again, about 7 years ago from today, 6 years ago. And I took her word for it. And, I let the property go. It fell over with finance. And then about 2 weeks later, I was introduced to this incredible broker called Aaron. And he said, mate, based on your position, you could buy at least another 2 properties right now. Now, I lost that opportunity. That home has just resold for $900,000 6 years later. So that one decision cost me over $500,000 or $500K. But I'm not concerned about that because, that every single investor in Australia has that sort of story where they missed out on a property and now it's worth whatever, or they sold a property and now it's worth something. But it was a big, big, big lesson for me around you're only as good as the quality of the team of advisors around you. Had I have had Aaron in my life at that point, who's a 40-year-old investor who owns 25 properties completely outright, I would have been in a position where I could have bought it, I could have cleaned it up, and I could have sold it for a really good profit, or I could have knocked it over and rebuilt it and had a property that's worth $1.2 million sitting there, which only cost me $600K to create right now. Now, lessons learned in this instance were, if you get a no from someone, especially if it's a bank manager or an average advisor, then go get a second opinion. It takes time. Another lesson that I learned is it takes time to build a world-class team of advisors around you. But through working with people like myself, you might be able to go directly to the source. So if you're a person looking to buy a great property in Southeast Queensland over the next few years, and you really want to talk about where you are right now, where you would like to be in the future, and what your plans are for this property, please jump over to my website, www.pumpedonproperty.com. Book a free strategy session in with myself or my brother Simon, where we can talk about exactly, what it is that you're trying to do and what's holding you back. And we can use our experiences of buying over $250 million worth of property in Brisbane in the last 5 years to help you get the best possible outcome for you or your family. Now, the third lesson that I learned, again the hard way, was buying property with friends. Now, I bought my first investment property with 2 of my best friends from Sydney. We went to school together. We bought the property when we were 24 years of age. It was a unit in a suburb called Miranda on the south side of Sydney, just near the beach. It had beautiful city views, beautiful water views, and was probably the worst unit in the suburb in a big block of units. But again, it was what we could afford. We bought it for $360,000. And if I had have kept it, it would be worth about $750,000 now. Now, what I learned had nothing to do with the actual property, but it had everything to do with the way that banks see people who buy with other people. Now, at that time, we didn't know any better, so we all bought together and we didn't think about the medium-term consequences. But, I remember having beers after we bought it, thinking we were absolute kings and we'd just crushed it. We were out at Bondi. We were talking about our plan for the future to take over the world and to keep buying properties together, to hold it till we're 50 and to sell it for a massive profit. and to go around the world for a year together. You know what I mean? Like, young man talk when you don't have partners, you don't have kids, you don't have businesses or responsibilities, and you're just like, yeah, we're balling. You know what I mean? Like, that excitement you get from those first few deals you do. And that naivety that you have, or that I used to have, which was, you know, there weren't videos like this. There weren't people sharing their lessons online. There were just books about these guys that were crushing it. And, you know, that was kind of the vibe that everyone had. So I bought this property, which was fine. It worked well for us. And then about 6 months later, I bought my second property. And then about a year later, I wanted to buy my third. It was at the time of buying my third property where I realized that the effect of that first investment was affecting my ability to borrow more money. And luckily I got that third property over the line. But then about a year later, I went to go buy my fourth. Now, it was when I went to buy my fourth that the bank said that I couldn't borrow any more money. And when I asked the question, they said it was because the first property that I owned was with friends, and that from a banking perspective, they were looking at me as I was liable for 100% of the debt personally, even though in my mind there was 3 of us, so it was just a third of that debt that I was responsible for. And they looked at the rent, and they divided that rent. They only took 80% of that rent into account, and then they divided that by 3. So from a rental perspective, you know, I was looking at getting less than a third of the weekly rent, but I was properly responsible for 100% of the debt according to the bank and the way that they were looking at my position. Now, this is a massive lesson for those of you who are buying properties with friends or brothers or even partners that you may or may not be with long term. It can massively affect your capacity if you start to go buy properties on your own without that person supporting you. So, huge lesson. If you're going to buy with other people, be very, very aware of the downfall and the way that the banks see it. What was the worst thing was that I, you know, wanted to continue on my journey, which I have. I've now bought 12 properties in the last 10 years, where one of my other friends has probably bought 4 and the other one's bought 4. And I made the really tough decision that I wanted to sell that property. Now, I said to my friends that I'm happy to sell it to you, but they didn't want me profiting from them. I even said that I was happy to sell it back to them at the price that I bought it for, but they made a decision after about 4 or 5 months of conversations that we'd just put it on the market. Now, this was just before Sydney boomed, so we sold it for about 430 or 440,000. We made a little profit. Each of us took our deposits plus about 20 grand back. Now that property's worth 650,000 bucks. The key lesson though wasn't around that. It was the effect of buying with my friends and what it did to my servicing, plus also what it did to the relationship with one of my friends for a year. Now, for a full year, he was so pissed off that I'd made him sell the property that he really didn't want to talk to me, and he was one of my best mates. Thankfully, we mended the relationship. You know, I flew down for his 30th birthday, which was big for him as a surprise, and that sort of put all the water under the bridge, and now we're absolute best mates again. He was one of the best men at my wedding, and I was one of the best mates at his, or best men at his. So, you know, just be careful about the way that the banks look at things. Understand these things before you go and do them. Sometimes it's better to wait another year, save some more money so that you can buy on your own, versus going out there and, you know, getting into it sooner like I did. And then longer term, especially when you want to buy that family home, you know, it might cost you something. Now, the fourth lesson that I learned the hard way, and I've done other videos with Ryan from On Property about this experience. If you want to check it out, it's on the On Property podcast or the On Property YouTube channel, and it's called Ben's Horror Story, where I talk about the full story. But a bunch of years ago, I bought a property in 2011 for $213,000 after the building and pest discount. And then I renovated and sold it in 2016 for like $540,000 or something. So I made a really, really good profit really, really quickly on that property. But what happened along the way is absolutely insane. So one day I get a call from my property manager, and she's like, Ben, I'm out the front of your property. It's on fire right now. I'll call you back later this afternoon. Now, I get a call from her about 3 hours later, and she's like, Ben, the tenants in your property have burnt down your granny flat. And I'm like, what the hell? And they're like, yeah, the tenants in the property have burnt down the granny flat. There's police at the site, and all of this stuff went down. Now, cutting a long story really, really short, when the fire department went through the property to find out what had actually happened, they found the second biggest meth lab or ice lab in New South Wales that year set up in that granny flat. Apparently they were cooking ice, and it was one of the most notorious drug dealers selling ice out of that property on the Central Coast. Now, absolutely insane, like, you know, that the property manager hadn't picked this up, but apparently the tenant in the last few inspections had walked around the inspection with her, and they'd padlocked the granny flat so that she couldn't see what was going inside there. And it's probably lucky that she didn't, because she might have got really hurt by someone. This was an insane experience for me. And again, the big lesson that I learned is always make sure you've got your insurance in place. Always make sure you've got your building, your contents, and your landlord, and always make sure it's 100% present and up to date, which luckily for me with this property it was. The other key lesson that I learned is that sometimes bad things happen to good people, and sometimes bad things happen to investors. And if you're not in a financial position with a buffer like I was to ride that bad time, I could have got myself in a really, really sticky and bad position. So it took me about 7 months to resolve, or 6 months to resolve the issue with the insurance company. That was 6 months because the tenant had completely trashed the entire house as well. That was 7 months without rent on the home, 7 months without being able to rent out the home, and 7 months without getting the insurance back from the granny flat, as well as the full renovation on the home after that. Now, you know, I decided at that point that I no longer wanted to own property in that suburb. Once I found out about the suburb in more detail, I'd made my money. I knew that it was the time in 2016, like I was saying on video at that time, that the market was peaking and it was time to cash out and make my money. Now, property prices in that area have declined by about 100k since, so it was certainly the right time to get out. But, you know, make sure you've got your insurance in place, and make sure you've got a cash buffer in place to ride the storms that come, because I never expected my property to get burnt down. I never expected insurance to take 7 months to pay out. I never expected to have to spend all of that money just fixing the issues that the people knocked down, or removing the granny flat and completely renovating the home that they'd completely trashed. So, you know, again, massive lesson that I learned the hard way. The fifth lesson, and the last lesson that I've learned, is absolutely my biggest lesson. Now, it's not one thing that I've done, you know, it's the lessons that I've learned from buying for over 450 clients now in Sydney and Brisbane, and it's a lesson that I've learned from buying 12 properties for myself, and it's from being obsessed with information and data non-stop for the last 10 years, and really having a passion for property investing and making the best decisions for myself and the people around me and my clients that I'm helping. But this is really a lesson that I learned through a collection of experiences. I truly believe now that if I had have known what I knew now 10 years ago, with the market cycle that we've gone through, I probably could have been between $2 and $5 million better off than I am right now, just because of following the rules that I now understand. Now, I truly believe in, if you've got a notepad or if you've got your notes on your phone, this is the time to pull it out. And I did another video on this recently, which you can check out, called How to Beat Market Averages, where I talk about all of these lessons in much more detail. But particularly over the last 3 years, I've really started to understand what makes a great investment and what makes an okay one. Now, this is based on data from CoreLogic, Heron Todd White, BIS Strapnell, Michael Matusik, and a bunch of other analysts in the marketplace, as well as a bunch of other advisors, as well as my own experiences of buying over $250 million worth of property now for myself and my clients. Now, the absolute number one rule for me personally, for my portfolio moving forward, which is going to help make me a couple of extra percent per annum than the average person that's not following these rules long term, is buy houses, because according to CoreLogic, houses have outperformed units by 96% in Australia in the last 20 years. Now, if you hear that information and then you still go buy a unit, you are fucking kidding yourself, because it is just such valuable information to know. If if you currently hold units in your portfolio, there's nothing wrong with that. But obviously houses, if you can afford them, would be the better asset to hold. Now, obviously units in Sydney and Melbourne in some suburbs have done okay, but in the rest of Australia, they've been really, really average and underperformed massively. Now, the second lesson is also from CoreLogic, where they did an analysis of the Australian market, and they found in the last 25 years, metro markets have outperformed the regional markets by 86%. Now, on top of that, Michael Matusik did some research recently where he looked at suburbs within 5Ks of every capital city in Australia, suburbs within 5 to 20Ks, and suburbs further than 20Ks. And what I realized from looking at that data is that suburbs within 20Ks of the city have performed at least almost 1% better in all of those capital cities per annum in the last 10 years, which is an easy 10% that you could make from just following that rule. And it makes sense. You know, suburbs within 20Ks of the city is where the jobs are. It's also where the incomes are. It's where the population growth is. It's where the key infrastructure is. And it's closer to work, which means it's, you know, got more infrastructure going in, and ultimately results in higher prices long term because there's a higher concentration of wealth in that area. Now, something that I'm aware of from my own research but don't have data backed by a third party to support this is that houses walking distance to the beach perform better. And Michael Matusik has done a study where he looked at houses on the beach with a water view, and generally those houses on the beach with a water view or on a lake or something like that generally sell for a premium and achieve above average capital gains long term. Now, if you think about that, houses, metro, close to the city, or on the beach, or with a water view are some of the rules. Some of the other lessons that I've learned is that you really want to be targeting at least 600 square meter blocks of land if you can afford them. You definitely want to be targeting long-term capital growth potential as well as great cash flow. For me personally, all of the investments that I hold in the medium term will all be dual income, producing great cash flow, so that one, I can have financial freedom sooner and choices in my life sooner, and secondly, so that when the next GFC comes through, I've got good cash flow and good equity, and I can borrow money from a bank's perspective when no one else can, and take advantage of the American, the Australian marketplaces, and you know, load up on properties at that time when everything goes on sale. You know, that's the last key lesson that I've learned. There's some incredible information out there from Phil Anderson, who I've done videos on, or that you can follow on Facebook or YouTube, as well as Fred Harrison, you know, as well as Ray Dalio, Warren Buffett, you know, Benjamin Franklin. There's all of these guys that have been looking at markets and cycles for the last 50 years that have incredible insight that you can learn from around timing. Now, if you can buy, like Warren Buffett says, when other people are scared, and sell to people when other people are greedy, that is the absolute way to make above average gains long term in whatever asset class that you're targeting. You know, the other lesson that I've learned, again, the hard way, is that buying and holding the right stuff long term is the only way to do it. Short term speculation, unless you're a professional investor or a professional developer, is so dangerous. And even most of those professional investors and professional developers end up, you know, going one too many projects big and costing themselves. And you look at their stories, they're just filled with battle scars, the same as me, because they've made so many mistakes along the way. So I believe less is more these days. I truly believe that buying a couple of good properties is much better than owning a massive portfolio. If, again, you're in a position where you really are thinking about this stuff, you're really thinking about doing something, you're thinking about getting into the property market, I'd love to have a conversation with you. Please jump over to www.pumpedonproperty.com. Let's book a complimentary strategy session where we can talk about where you are and where you want to be in the future. Let's talk about what's honestly holding you back and how we can help you move through those things. And let's talk about how you can take advantage of the next real estate cycle that's coming as we speak. So really appreciate your time. Please subscribe to this YouTube channel. Please give us a thumbs up on this video. Please comment about some of the experiences that you've had, positive and negative, in property below. I truly wish you all the best, and invest with confidence.